Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asad Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
67% of sellers say they've watched deals slip away because they couldn't deliver the specific customer evidence their buyers needed. That's why this episode is sponsored by User Evidence, the customer evidence platform trusted by GTM teams at Gong, Ramp, Grammarly, and more. In their latest report based on findings from over 600 B2B buyers, sellers, and marketers, they reveal exactly what kind of customer proof builds trust and gets deals done. For all of the findings, download the Evidence Gap report now at userevidence.com/evidence.
Hey everybody, it's Sam Jacobs, the CEO of Pavilion. Welcome to Topline episode 118. I'm joined by my co-host Asad Zaman, the CEO of Sales Talent Agency, and AJ Bruno, the CEO of QuotaPath. We're also joined by a friend of the pod, our very good friend and one of the leading experts on what's happening in startups today, Peter Walker, who is head of strategy at Carta. Today we're going to be talking about the Windsurf acquisition by Google, and whether the employees got screwed. And we'll also be digging into the state of startups based on some data that Peter always is happy to share with us. So let's get into it. Hey, everybody. How are you? AJ, how's it going?
Good. Peter, how do you feel about that bio that Sam just gave you?
It's literally never the right title, and I love it. Not once has my title been stated correctly on this podcast, so everyone it will need.
I think Head of Insights is a dumb title. It's a dumb title.
Look, I didn't realize this was going to be a group therapy session. This is supposed to be for Windsurf employees, not Carta
Chief
employees.
Insight Officer at Carta. Sorry, Peter.
Man about town, you know?
That's for sure. We were talking offline. Peter, tell the audience, how many speaking opportunities have you executed in 2025, both in person and virtually?
This, if you count any speaking opportunity as speaking to a group of like 20 or more people, this will be around the 65th time I've done this year.
Wow.
I mean, I don't know. Do 20 plus people listen to the pod?
We
joke.
We hope.
If you listen this week,
and we'll get to 21. That was sweet.
I mean, Peter, that sounds like a job title of the head of strategy, though. Like
it's true.
So.
You know, it is true. I think actually most heads of strategy don't spend their time on stage, or they shouldn't.
AJ, how are you?
I'm great. I got back from New York City at 12:30 a.m. last night and saw the live recording of the acquired podcast. Cool. Yeah, which was awesome. I guess I'm allowed to say who was there because it's already been announced or whatever. There's other people who are taking things, but Jamie Dimon spoke for 90 minutes.
Oh my God. Isn't he the best?
He is the best. He's the best. He is the best. He talked about getting fired from Citigroup in 1999.
Oh,
and and then he talked about the great question that was asked. That was just the right question. Like, over your 30-year career, you've been able to sustain some of these traumatic economy issues that have happened over those years. Like, what are you doing that's different? And he's like, well, we're just not getting crazed by all of these new trends, and so when new products come out, we're not leveraged to the teeth. We, during the financial crisis, did have some subprime exposure, but not anywhere near the exposure that anyone else. He said, I look back at it and I wish we did less exposure to it. So
I'm sure many people feel that way.
I'm sure.
I don't know how unique of an insight that one is.
No, but like the long-term value is what stuck out to me. And he said, I just put myself in the shoes of our clients and just show from an empathy standpoint, are we doing the right thing by our clients? And we're just always trying to do it. The other interesting thing he said is that they spend $800 million in cybersecurity a year. And that is, he said, by far the biggest threat to the global world and just stability across the world. You know, he was like very clear. He said China is on their own playing field when it comes to cybersecurity, and he said Russia, but that's more criminal than anything. And everyone laughed at that, but he was right. Like, the bad actors in China are probably more coordinated than the bad actors in Russia, would be my guess, is what he was talking to. So
he's also like a machine, works 7 days a week. He's old, like he's not a young cat and still works 7 days a week. Is
well, he was 42 25 years ago, so I guess he's 67. Yeah,
that's inspiring. That can be us.
Yeah. I'm doing well. I have my board meeting right after this, Sam, as well. So
I think we're going to talk
about. AJ's going to work the whole morning, guys. It's pretty awesome.
we're gonna talk about this in the docket, but I think the subprime example is relevant today because it's just about hype. It's just about mania. It's just about when everybody is telling you this time it's different and piling into something. Can you keep your S together, keep your head focused, and really just play a longer term game? And obviously, I think we're going to talk about that when we talk about the quality of some of this revenue when it comes to coding assistants and just the general AI craze. And I think it's the same. And there's a company, by the way, that is, one of the hot AI companies, and I'm friends with them. And I got a bunch of like expert network calls, requests. I didn't take the calls, but requests, which I determined to mean that they were in diligence after having just raised a big round. And I messaged them, I texted them, ad hoc, and said, I really hope that you manage your valuation appropriately. Like if you're going to raise a big round, you better take some money off the table because you don't want to be hopping, hopping. I guess the guy took a bunch of money off the table, but you don't want to be, you don't want to be pushing valuation and not seeing anything for it because you really don't know how long this stuff is going to last. And then you're saddled with a valuation.
Well, it won't be much of a problem for them. It seems like from what I hear, investors are very open to a lot of, companies are doing more secondaries for founders than the revenue in the organization, which is interesting. You have 2 million in revenue, you're doing 10 million in secondaries. That's fascinating.
So I think I know that was like an Arthur Rock tweet recently. I think that's a little overblown. It's not like the company is taking secondaries for 10 million, but yeah.
There's always the exceptions, Asad. I think this was 3 years ago that was true. I definitely know that was true. I don't think it's
one second. You're telling me an AI company with 2 million raising at a $500 million valuation would not have founders over there not walking away with 3 to 5 million?
But there were hundreds of those type of companies in 22. There's maybe a dozen of those type of companies today. Or maybe that's my read on it.
I think there might be a difference. It's definitely happening.
Yeah. Well, Sam, to your point on the this time is different. That was actually, Jamie said that. He's like, everyone thinks this time is different. And that's where we actually are more conservative when everyone says that over and over again. That's the
one thing though. That's one of those Ray Dalio type of things that you can say and sound smart all the time. But the reality is sometimes it is different. And that's what makes it hard. Sometimes markets change. Cloud changed the market. Today, cloud itself has more revenue, the cloud providers, than all of software put together when these companies entered the market. So things do change as well. And that's what makes it hard to know, is this time different or not? Because sometimes it is different.
Yeah.
I'll tell you one thing that hasn't changed going back, 100, 150 years, which is the equities markets generally go up, and that human productivity seems to have increased. And I think it's really interesting because I think people are talking about the Figma IPO, a $20 billion IPO. And, talking about a $20 billion IPO a couple of years ago would have sounded heretical. It just sounded crazy. And now we have multiple $1 trillion companies right now, which is.
We have a $4 trillion company.
$4 trillion. Can you believe NVIDIA has.
There's a $400 billion private company. SpaceX is at 400 billion. If you believe the last secondary is at $400 billion.
Yeah,
that's crazy. It's a completely new world.
I've told Sam and Asad this, but I bought into SpaceX like 12 years ago at 9 billion, and I have no idea where that is. And people are like, "Well, you just go look at the secondary market." I'm like, I don't even know where to start with that right now.
Just hold that.
Just hold
it. If you were selling, I would buy it from you. The minute you want to get out of that, you tell me. I'll buy all of it. You don't need to do it anymore.
That's a big no thank you from me, AJ.
One other note that's relevant for us, which is actually was so cool to hear, was Jamie's perspective on SVB. He spent like 20 minutes talking about it and what happened and directly happened. He didn't call Peter Thiel out by name, but he definitely said there were like some he didn't say bad actors, but he said like there were some folks in the Valley that just caused a panic around it. And he was like, we actually looked at that business and they didn't end up buying. First Citizens did. And they didn't end up buying is because, well, QuotaPath was an SVB customer and we had to move our money. We needed to go to the safest place we knew. So we went to JP Morgan, and 95% of other SVB companies did that. So what would JP Morgan be buying in that instance? Yeah. They had our money at that point. So I found that interesting, but he talked about retail and the things that SVB did really well, which I do miss, is their client one-to-one, like the one-to-one, and they were so good at it. And JP Morgan, just different ball game. So that was cool to hear.
That was a little bit of what screwed them though. Like they went a little bit
for
too
sure.
far. Right?
No, it's exactly what that was the point.
Founder friendly.
100%. That was the point.
That didn't screw them. Like mismanagement of long-term.
I think the combination
of not understand interest rate. Like that's what screwed them. Is like
they operated for a year without a chief risk officer, so they didn't have oversight in that area. But then the combination of that and being extremely founder friendly, because they would also do things that would make you question, like, oh, interesting, you're doing that. And the combination of those two things, when the market turns, it can kill you.
And this is episode 1 of Topline. Here we are to the beginning.
I will say that did, I think about that a lot because I remember we were all on group chat and we were all in Slack. And I remember certain people talking about how they'd gotten, $40 million out of SVB in the morning, and then other people couldn't get their money out at all. And the system never felt more rigged than when SVB was collapsing, and to the point of Peter Thiel.
So to the point of Peter Walker, the head of chief strategy officer at Carta, I'm just kidding. I'm kidding. The thing that Jamie did talk about was that these products, the way they had their books, and they had, we were part of this, where they had a lot of their dollars that companies like QuotaPath were actually had in like T-bonds or different accounts were counting. SVB was counting it under management, and it shouldn't have been counted. And I think that was a big part of the friction point. And we couldn't get our money out because we were part of these sweeps accounts where we literally had our money somewhere else on a nightly basis. It got pulled back in, but we didn't have enough time to do it. So saw this firsthand.
Yeah, we had the same experience. I mean, that was a really rough weekend for everyone at SVB, but everyone at Carta was on the phones, hearing fund managers calling about, can we take our principal out and put it into personal accounts? Like, that is 100% illegal. Do not do that. and then JCal tweeting in all caps, like, the world is collapsing, but barbarians at the gates. Like,
I think it worked out for him. I think he
did. Oh, surprise. Yeah.
Okay, let's jump into the actual docket, but that was nice, AJ. The first thing we want to talk about is this Windsurf fiasco. So the background here is that code gen as a market is a pretty significantly sized market. 27 billion by 2027 is a conservative estimate. And the reason for that is one of the strongest use cases for AI today is code generation. When you look at the benchmarks, Claude's top model scored 72.5% on the SWE benchmark, which is a real world coding benchmark, and OpenAI's best model scored 68%. So that has made this a very competitive space where you have a bunch of startups that have set various records: fastest company to get to 100 million, fastest company to get to 500 million, et cetera, et cetera. We had one of them on the podcast, Bolt CEO, who was really fun to talk to. So you've got a bunch of these startups that have accelerated aggressively, but you also have companies like OpenAI and Anthropic that look at this market and want a piece of the market, want to own the market. And so they're coming into the market as well. And that's created a really competitive environment. One of the companies that accelerated quickly and was doing well-ish was a company called Windsurf. And they got to 82 million in ARR. And having just released a product last year that is the backbone of this acceleration, that's really impressive. But they were behind Cursor, which is 500 million, and then OpenAI and Anthropic are making big moves here. And so that made it so that it was difficult for them to raise the type of financing they would need to be extremely competitive. So they were looking for an off-ramp, and that off-ramp came in the form of OpenAI looking to acquire them, which was announced a couple of months ago for $3 billion. And then everything went quiet for a while. And then last week, a bunch of shit happens. So first, we hear that OpenAI and Windsurf, their thoughts fell apart. then the thing they're saying is it's because through the acquisition, Microsoft would have gotten access to the Windsurf IP, and that's what led to the talks falling apart. Then Google comes in, steps in. There's a meeting with 40 of Windsurf's employees with Sergey Brin, as well as the DeepMind crew, where they basically told them, we want you 40 people to join us. We're willing to pay $2.4 billion. We'll license the technology, but you have another 250-ish employees. We don't care about them. And so then this happened, and what got left was this Windsurf entity with none of the technical folks that were great, 100 million on the balance sheet. Good luck. See you later. Now this is where the market was, and everybody was very frustrated that how can a CEO and executive team leave their soldiers behind like this? This is disgusting. Then out of nowhere, Cognition steps in, acquires that organization. And that's where we are today. So the first question is, and Peter, maybe we start with you, because there's a new style of M&A that's happening now, right? Which is this sort. Why do you think this is happening? And for the audience, can you maybe define what's different about this sort of M&A from the sort of M&A we're used to hearing about?
Absolutely. So there's a lot of examples of this happening at the moment. Scale, character, inflection, all of these are AI companies.
Adapt.
Effectively, this is a acqui-hire by any other means. The reason it's happening, at least the stated reason it's happening from many of these companies, is that the actual path towards executing an acquisition takes too long, has too many regulatory uncertainties. So we're going to try to get at the value a different way. What's really happening to me, and this is illustrated, I think, very neatly by the way that Meta is paying for AI research talent at exorbitant rates, like rates we have never seen before, is there has been a bifurcation between product and talent in a way that we have almost never seen. Yes, there have been acqui-hires before, but look at the Google deal. They could care less about having Windsurf tech. That does not matter. That is not the point of this deal. It's Windsurf people. Yeah. Specifically Varun, the CEO, and like a dozen or so other engineers. That is the core thing that they care about. And they will acquire that piece of it if they can, and then try to do some regulatory dancing with the licensing fee, et cetera. I understand that from the big player side, and it makes total logical sense. The reason that there was such a blow up over the weekend was, Asad, you said it well, like, was this CEO and exec team just saying, screw you, to the rest of the 200 plus employees who did not get to make the jump from Windsurf to Google? I personally think yes. I think it's actually bad behavior. And
it's
yes,
hard to argue no, actually. Like, it's very hard to argue the other side of it, but go on.
And people do, because Cognition, the other startup, came in and actually, played a savior role here and bought the rest of Windsurf, and is now, so Windsurf employees, all those 200 who didn't make the jump, are now working for Cognition. So it all ended up pretty well and neat. There was no reason to expect that would happen, exactly. Right? So like, as this negotiation was going on, it was a very clear, we're going to leave this team behind. We're going to give them some cash on a ghost ship and say, good luck. And people say, oh, but what is the value of Windsurf? Surely it's not zero. Kind of it is. If you take the CEO out, take all the technical talent, and say, as we just noted, an incredibly competitive space, and say, good luck to you. What do we think the revenue of Windsurf would have been 18 months from now had Cognition not stepped in? To me, it is an abandonment of those employees. And it does sort of abrogate one of the unspoken rules in the Valley, which is like, if you do well, acqui-hires for a company that is not doing well are different. If you're doing well, you should take care of the employees. And I don't think that happened in this case.
Sam, when you hear this, the question that I think comes up was the Windsurf CEO being fairly pragmatic, or is he a loser for doing this?
$1 billion. I think it's hard to call someone that makes. No, I know, but I'm saying, like, in terms of what he personally took home, it's probably around that, because it was distributed to a few different people. So let's say he made $1 billion. It's very hard for me to call that person a loser for trying to execute this transaction. I think if this is going to be, we still don't know. I think I have two thoughts. The first thought is, you can say this is a constant trend, that the researchers and the talent is far more important than any of the tech. And this is a persistent trend. I don't know that maybe, I mean, we could argue both sides, and I'd have to sort of think through all of the different implications of that. But I also think we're in this period of great upheaval, and we don't know where the dust is going to settle. And it may be true that products do become more important, and the teams that build those products and the organizations that build those and develop the go-to-market motion become more important. This is a blip in time. If it's not a blip in time, that's a much bigger issue. Where it comes out is that, in all of the research that we were doing about this episode, we were talking about, corporate attorneys and having to think about how to structure employment agreements in new and different ways to prevent this. And if it happens persistently, I think we definitely do. It was the Windsurf CEO being, a loser or a jerk? I don't think it's great behavior. I think there's ways he could have negotiated for different kinds of outcomes and taken some of those billions and allocated it out to the couple hundred people that work at Windsurf, and everybody would have been very, very happy. And when you're making $1 billion, I think you can take $100 million and distribute it to people to make sure that they're taken care of, for sure. And, even when I made far less than that a couple of years ago, I made sure that everybody got a cash bonus, even people that were unvested, because, if I fundamentally believe, like, if the owners are participating, then the employees should participate. So I do agree with what Peter said. I think it's going to come down to how we negotiate. I think it's going to be really interesting new wrinkles on negotiation, on employment agreements. And I don't know how you're going to do that. It's a very strange thing to go into a negotiation with a CEO and you're going to be the CRO. And it's not really, it's not even acceleration, right? You're not even arguing for equity acceleration because the equity is
double trigger doesn't play out.
It's not an acquisition. It doesn't qualify.
So it's like a deal bonus. It's probably a transaction bonus of any kind. It's like any change in control, any meaningful change in ownership structure, you are immediately not the CEO and this other event happens. So there's still like maybe triggers that could be created. And in that case, I don't care what happens. You give me $5 million. Maybe that's like some way of structuring it.
And I think go-to-market and just business lines generally are the most screwed over here. Because if this keeps happening, let's say this happens more and more, these companies don't even want your tech. They don't want your revenue. They don't want your customers, and they don't care about your salespeople. They're looking to just get a couple of technical folks over to them. And so the people that get left behind most often include a big chunk of go-to-market, which happened over here. AJ, you know a bunch of the people. You've said previously that a lot of your old team works at Windsurf. They used to work out of your office in Austin. So you might have some insider perspective. How did this feel for employees that got left behind? What was the emotional burden put on them?
Yeah, without going into specifics and names, because there's a few people that I messaged, the general sentiment was very positive from all of them. And they all said it was the craziest 72 hours of their lives. Some were involved, I'm sure, at the top level in this negotiation, because you're
positive at the end outcome, because a lot of the people you spoke to were the ones left behind. They were positive that it all worked out in the end.
It's been less than 2 days from what is the end? What is this? What does that even mean? We don't know.
Found a home. They were left for dead, and then they found a home. That's
I think this is also new and fresh. I mean, look, just 3 months ago, Google acquired Wiz for $32 billion, by the way. Did something change where Wiz could have gone through a similar acquisition path for why was Wiz not acquired for $2 billion for the founders and the top team as well? And I just have this sense that Google is just like trying to respond probably to Meta, probably to Zuck in the AI researcher race, and dealing with the non-competes later. Like we'll pay out the whatever it go to court.
Well, it's in California. So
no non-competes.
There's no non-competes, but there's still going to be lawsuits. We all know this to be true. You think, here's the thing that I don't understand. Who's left carrying the bag most likely at Windsurf? The investors. Who doesn't like, no?
Massive dividend.
They got paid out totally fine.
Yeah. They did?
Yeah, they got the dividend. Basically, the 40 people
shares. They were fine. That licensing.
But wait a second. What was the original acquisition price for the Google?
$3 billion.
Or for the OpenAI?
$3 billion.
$3 billion. And so the investors got paid out at that valuation.
Yes. The way this works, so this started because of Lena Khan, and now it's basically been done because of the speed aspect that Peter spoke to. And so what it is we license your technology as a mechanism to give you a bunch of money. We actually don't care about your technology all that much, but we use that as a mechanism to give you a bunch of money, which you then dividend out to people that have vested shares, if you decide to, as well as your investors. They don't get a big return, right? 2.4 billion is not, this is a home run, but it's a ones or twos. And so everybody walks away happy-ish. And the people that are left holding the bag are the people that were left behind. Go-to-market, ops, finance, all these people who are basically being told that in the most technical competitive space in the world, good luck. We gave you 100 million on the balance sheet, good luck.
Yeah.
And
now,
they're the ones
you could make the case, and people have made the case, that the reason that $100 million existed on the balance sheet as part of the deal was because whoever was left at Windsurf was going to be an entirely employee-owned company at that point, and they were going to basically dissolve it and pay out that $100 million to whoever's left. Maybe, to be honest, like the way that it's written in the information and others, this Cognition deal that came in and saved the day did not happen. That happened over the weekend. Like it happened on
Friday evening, 5 p.m. The conversation started. It ended on Sunday, and the deal happened.
So and the difference, I think, the real big difference, at least when we look across our startup agreements, is that it isn't as though every acquisition you bring along the whole team, but double and single trigger acceleration clauses do exist in many of these option grants. And the other thing to note is they were being left at that company. They don't get to go ahead and say, okay, my unvested equity becomes Google equity, which is cash. They get to say, you have more equity now in Windsurf. This
something that is worth a lot less now immediately.
Yeah.
What would you say the enterprise value of Windsurf after all this is? You have 80 million in revenue, you have 100 million in cash. You're probably worth like 100-ish million. You're probably not worth all that.
Well, and also think about the people that were negotiating this starting on Friday at 5 p.m. They are probably maybe at the management team level, most likely.
The CEO.
But they're
new CEO.
New CEO.
Oh, hold on. Sorry to interrupt, but the 80 what you just said, Asad, that just doesn't make sense.
Ask the question.
No, you're saying it's worth 100 million when it has 80 million in revenue, 100 million on the balance sheet. So first of all, we know that it's worth 100 million. And second of all, we know that if the revenue is worth zero, then Bolt is worth zero, Lovable is worth zero. All of these companies are worth zero. The revenue is supposed to indicate. Okay, well that's a fascinating,
a bit of a hot take.
Yeah, there's
now we're getting the good
is that okay? Who is going to want to acquire this company, and what is it truly worth? If you went out to raise money today, what are you going to raise at? You can look at it from a couple of different angles. My perspective is that 82 million is going to churn the hell out in like minutes, right? Like Peter made a good point. 18
but not
months
for Windsurf.
Now,
they build an
how much of that 82
business.
million is still there 18 months?
That's not true for Windsurf.
It's not going to churn out in minutes. The whole point of recurring revenue, if it's truly any kind of, you wrote the newsletter that said this is real money and all the naysayers should go to hell. Yeah. You're the one that said it's real revenue. If it's real revenue, it's far stickier than just some guy left, so we stop using your tool. Like if the tool is embedded and there's some kind of enterprise procurement process they went through, then the company is worth
That's why 18 months, right? The 18 months number makes a lot of sense. 18 months in, renewal cycles go by. This product hasn't been advanced. You've lost your entire technical team. You have no technical team building a developer tool for developers.
I mean, I would definitely, if you wanted to be on the other side of a trade where we were betting if Windsurf was going to be worth more or less than whatever, multiply some churn rate, take a 70% gross margin on the 80 million, so like 50 million going on to 40 million. I would take the over on 250 for sure. If I get to add in the 100 million
I'd take the strong under, Sam. I take the exact opposite position for two reasons. One,
this is a great episode. Let's go, Dragon.
One, yes, on the technical talent side, like it's not just that your CEO and all the quote unquote best engineers left. It's that everyone knows about it. Everyone in the Valley knows about it. And you're
using the brand. This is a brand issue.
Totally.
All right.
Second, the most important is the Windsurf fork on VS Code drives on Anthropic. This is one of the major reasons why the OpenAI acquisition was going to be tough, etc. What is Anthropic building right now? Claude Code. Why, if I am on Windsurf right now, why do I not use Claude Code in 18 months?
Yeah.
I don't understand that.
But what would be different if Varun was still there?
They would be building
They
a
would be
better
building
product
and
every
have
single
technical
day.
talent to stay ahead. I mean, it's the same way that you could say Cursor is going to get eaten by the foundational models. Like, this is so close to the foundation model that any change there, I think, is an easy tip. We've been talking about the reliability of AI revenue. I think that this IDE space is the perfect example of whether or not it's actually sticky.
Well, yeah, I think that's going to be like the key question, because I also think, well, you all educate me, because I think there's a difference between, but maybe there isn't. Is there a difference between code assist and code gen? Because the people, I think some of the ARR or some of the revenue around code generation, meaning people vibe coding and building new applications that are somewhat non-technical, I am hugely bearish on that. At least for right now. Maybe at some point it becomes useful or good, but every person I've known that I think the first thing you do is you enter a prompt and you get like a wireframe and like a mock-up that looks interesting, and you're like, oh, this is so easy. And then you try to take it to production and you're dead 4 days later, which is basically what Lemkin said. What do you think, Peter?
No, I think there is a difference, right? The difference between a lovable built for hobbyists is a rude term, but like you understand the idea behind that, versus a co-pilot built for enterprise code teams that are all technical, etc., except for the fact that the more technical your product is, to my mind, the more it matters that you have the best technical talent and a CEO who knows what he's doing. So like that to me is, I just don't think if Cognition hadn't stepped in now, and this is a great example, we don't know what Cognition paid for Windsurf.
Right.
We don't know what they valued the rest of that company at. My instinct is they valued it at a hell of a lot less than 2.4 billion.
Oh, of course.
Yeah. Like, so it's maybe we're arguing semantics here. Like, is it worth more than the cash on the balance sheet? I think yes, but is it worth a lot of money in 18 months?
I don't think we're not worth. It's not semantics, because your point is the enterprise revenue isn't sticky at all, and my point is like it should be somewhat sticky because you had to make it through the sales cycle and it has some reliability. And I think what we're talking about right now is maybe there isn't that much durability in this revenue. If all of the revenue can evaporate if one person leaves, that tells me that should be a fairly massive discount on the enterprise value. Maybe the talent value is very high, but if one person leaves and all the money goes away, I don't know. I want to make that bet. The person could have, the guy could have gotten hit by a car, not just, go work for Google.
But it's not one person, right? Sam,
not
it's
one
40
person.
people.
Yeah,
it's 40 people that are all your top engineers, all your top researchers, and the guiding light of the organization, the founder CEO. So they're all gone now. What's interesting about the acquisition is Windsurf has two products, actually, Windsurf and Codium. And one is enterprise, which is Windsurf. And Codium is actually the vibe coding tool. What Google bought them for was actually the vibe coding one. They didn't buy them for the enterprise tool. They bought them for this vibe coding one because they want to compete in that market. I would bet that the chances of Google being one of the top, them being number one in that space post this acquisition is close to zero. I would bet $10,000 to charity that in a year from now, Google's not in the top two in that space, even though they've made this acquisition. Personally, I feel...
I'll take that bet.
Sure.
I would take that bet.
Around.
You betting against Google?
I need a sticker that says like who owes who what.
Yeah, done in a second. I think people are being generous to this CEO. I think he's a spineless loser, to be honest. I think the fact that he was willing to do this to his team says a lot about his character. And personally, I think this whole Microsoft OpenAI thing that is the reason behind this deal falling apart is crap. I think that's PR spin. I think OpenAI got to know these people, and part of the acquisition would mean Varun having an executive seat within OpenAI. And they're like, I don't want this character to be in that seat at OpenAI.
Do you have any inside information?
No, this is just my perspective. I think it's more so like, I don't want a person like this in my exec team. Off he goes. And then a company that's fighting on its knees, fighting for relevance, which is Google, comes in, swoops in, and acquires him. And the combination of a company that has been unable to gain relevance over the last couple of years, even though so much of this innovation came out of them, and a guy like Varun is not going to lead to great outcomes. So AJ, you are going to lose that bet.
Okay. Whoa. Let me ask you this, Asad. Where do you put Gemini in the top of, from a large language model?
Top 3, top 4.
Great. Episode
now
53.
go 1 second.
Episode 53 of Topline, you were trashing Gemini. You were trashing Gemini and saying Google was done.
I would still trash
Google's
it.
not going anywhere.
As a technical model, it is great. Who's using it? Who's using it? What's their
Gemini?
user numbers?
We use Gemini. Use Gemini every day when you're doing a Google search.
They're not in the top 3 from a usage perspective. And then Google has Gemini. Now go buy Google Home and ask it to tell you the time, and it'll tell you the weather. And then ask it to set up the stopwatch.
I'm big Amazon Echo users over here.
AJ, don't out yourself that way. Come on.
Are you ready to level up your go-to-market strategy for 2026? Then don't miss GTM 2025, the only B2B tech conference exclusively for go-to-market executives. Join 1,000 other revenue leaders this September 23rd to 25th in Washington, D.C. for an exclusive executive-only experience. This 3-day event is hyper-focused on connection, strategy, and execution. Expect hands-on workshops, in-depth strategy sessions, and curated opportunities to build relationships with VPs, CXOs, and founders facing the same challenges you are. You'll stress test your GTM approach, align your team, and lead with real, actionable insights from top-performing leaders. Don't miss the must-attend conference designed to help you boost go-to-market results in 2026. Visit attendgtm.com, that is ATTENDGTM.com to secure your spot today, and don't forget to use the code TOPLINE for 10% off your GA ticket.
Let's transition a little bit, because I think that there's a bigger implication that we're alluding to, but not quite talking about, which is what does it mean for startup employees?
Yes.
And particularly for go-to-market employees. You know, what do we think happens to all of the sales, like all of the people that you still, as far as I understand, I mean, we talk about this every week. I still think you need a go-to-market motion. I don't think everything is PLG. I don't think everybody's just signing up for stuff on their own. So you need a sales team. They're delivering enterprise value, even if the enterprise value they're delivering is just confirming there's a need, even if you discount the revenue. But you're like, no, people like this thing, they want to buy it. So what happens
Sam,
to startup employees?
When Apple buys me QuotaPath for $5 billion, I will take care of QuotaPath's employees. So if you're out there,
what about your
QuotaPath,
You heard it here first, everyone.
What about your podcast co-hosts? Please, please.
Asad gets my SpaceX shares. Asad gets my SpaceX shares.
You better be both on the QuotaPath cap. Come on.
Does everybody feel a little poor when we're not billionaires right now? It just feels like there's this world of have and have-nots.
Absolutely not. I think the type of thing that Varun did is the actions of a person who's trying to fill a hole within their soul, and you can't fill it with a little bit more money. And I think I would hate to be in his position. I think it's a very bad situation to be in.
Okay, Asad is coming in spicy today, and I absolutely love it. Let's take this maybe to a slightly more technical level, which is, Sam, you asked the perfect question. What happens to startup employees now? So Ben Thompson wrote about this.
Graham, did you hear that? Did you hear that? I asked the question.
Ben Thompson wrote about this in Stratechery a day ago. And like basically the conclusion, where we can talk about the technicalities with actual equity and how you write single and double trigger acceleration and all that kind of stuff. My general point, and I agree with Thompson on this, is that it is now a higher bar to join a startup. You have to, what are you doing? You were always betting on the CEO. But now, even in a good outcome, you have to rebet on that CEO taking care of you. And that's always been the case, but maybe it's never been more apparent than it is right now. And so that's, if you are choosing between big tech and little tech, the prospect of making a ton of money from little tech gets harder and harder. And that, I think, is what's new here. The other point that I'll make is it could be, Sam, that this is really a blip, right? We're talking about an AI research moment. These license / acqui-hire deals are not a new normal. They are just like a tiny solution in search of this problem that exists today. Or you could say that now that big tech is getting interested in this kind of acquisition, we're going to see a lot more of it because it closes so much faster. You get the team next week. You don't have to wait for a year. There are structural advantages to structuring a deal this way that do not exist in acquisitions. And I kind of think, and again, I'm stealing from Stratechery here, the reason it hadn't happened before is just kind of like norms. And now it has happened. So now you have two kinds of potential acquisitions all the time. And I just think that there's a possibility that we see a lot more of this.
Are AI companies the only types of companies that are going to get this benefit?
Because it's only for technical talent, right? Like what's become really interesting compared to standard M&A is that standard M&A used to be about you're acquiring the overall instead of you're thinking of building, buying, or partnering with an organization, and in many cases you decide to buy them, and you want their customers, and you want their technology, and then you want some of their people as well. In this instance, you don't want their customers, you don't want their technology, you just want some of the people. And those are the researchers and the engineers. And I think if we were to say 2026, 2027, 2028, do we think that there will still be this race to find breakthroughs to make these models much, much better than they are today? Are we still in that race, or have we reached a point where the most ultimate model has been created, nothing better can be created? I would take the former situation where we're still trying to get better and better and better, in which case the demand for this sort of talent will greatly outweigh supply, which won't just increase compensation for the people as we've seen with Meta, but will increase the types of things people are doing to acquire them. And so in my mind, this type of acquisition increases. It doesn't decrease. It happens within big tech, or some large private companies would do it as well. But it keeps going on. If that's the case, the downside for everybody else in these organizations is significant, because it's happening at a point where the leverage of the average employee is decreasing, right? Like if AI makes companies more efficient, that by nature reduces the overall demand for people to some extent, and takes a little bit of leverage away from the average employee. That with that lesser leverage, can they negotiate the things that they would need to protect themselves in these instances? Executives might be able to negotiate some quirky, interesting things, but the average person probably doesn't have the knowledge or the leverage in that equation to be able to do so. Do companies shift to a monthly vesting schedule? Unlikely, right? And so it feels like this is actually...
Wait, hold on. What do you mean companies shift to a monthly vesting schedule?
Do they just start vesting stock options on a monthly basis
instead of a one-year cliff?
Yeah, this would take care of a lot of it, right? Because everybody would have some level of vested stock. Because in the Windsurf example, one of the things that was really interesting was more than 100 or so of these employees were hired in the last 12 months as they expanded out, right? They left employment, they said no to other companies, they came here. And those people are the ones that for sure got nothing. And so if you had a monthly vesting schedule, they might get something, but would organizations do that?
I don't even know if that's true though. I mean, and maybe Peter can talk to it, but if you're not exercising those options, you don't own them. So they don't have anything, even when they're vested.
It depends on the way that the acceleration would work. Like a lot of times the vesting would include, the only thing that really mattered would be the vesting, not the exercising. Although, AJ, you raised a very important point. Like all of this is messy. But Asad, I think you made the key point there, which is employee leverage. Let's put a little bit of stats on it. Companies on Carta hired 70,000 people in January 2022, 40,000 in January 2023, 32,000 in January 2024, and 20,000 in January 2024.
Oh my God.
Down and down
People
and down we go.
Are not getting hired at startups, and therefore each individual negotiation by an employee to their employer, good luck getting them to change a part of your equity grant.
Yeah.
I mean, all of the power, I mean, listen, we're CEOs. It certainly benefits us, I think, in some way. I mean, there's got to be downstream ripple effects, even if we're not AI researchers. Yes. But it really feels like, I mean, it's been true for all of human history, but the people that have capital and the people that own, that have stock, literally, in the traditional sense of the word, like the people that own stuff, the asset owners are separating themselves even more from the workers.
Even more importantly, if you have liquidity, the ones that have cash are the ones that are able to really have leverage. And I know like that's been through the history of time as well.
Not just
but
cash,
I think
because these guys didn't have cash, but what they had was a collection of people that was the best collection.
Well, I meant on Google's side, like if you're at the haves and have-nots at that very, very high tier, if you're Google and you're just stockpiling cash and you're like, well, the government's going to stop me from buying what I want to do, so I'm going to look at deals differently. This is what happens. This is what you do.
I just think it's it feels to me like a new moment. Now, look, again, maybe this only applies to a specific tiny sliver of companies. To your point about Wiz, like they were buying Wiz for the tech as well as the people. That was the difference there. Yeah. They wanted the product.
I mean, it was a 10x acquisition than
fantastic.
what this is.
Fantastic outcome for Wiz and everybody there. This just feels new, and it just makes your decision to join that Series A company that much harder. That's really what it comes down to.
That it doesn't play out that way, because I think a lot of people that are early, the ones that I worry about the most are like ICs and people that are in the non-executive positions, and they don't have the acumen to even know too much about this stuff. Like, I think it takes a while for this to happen over and over again, for that general knowledge to settle in. So I think over the next bit, we'll see more and more. Listen, the hope I have is that Varun is a unique example in this situation, and there are more founders who have the generosity in them to say, if I'm making $500 million, let me carve out a little bit to just take care of everyone, because we were a team and I was the general and they were the soldiers, and I shouldn't desert them like this. And I would hope that more people do that. And if that happens, that's great for the market. Probably that doesn't happen, and it probably takes more of these situations for that general awareness to settle in, because in this situation something quirky happened, right? Devon came out of nowhere, or Cognition came out of nowhere, and it was a very synergistic acquisition for Cognition, because they're trying to build this autonomous software engineer, but they're not there yet. And so this gives them kind of an on-ramp to that future that they're building. If these type of acquisitions happen 100 times, how many times does a Cognition step in to save the day?
Yep.
Probably not even 5% of the time. And so it's going to happen more and more, but it'll have to happen more for that awareness to settle in. So in the near term, I think that there are going to be a lot of people that will feel deserted, that will feel like, I got in and you sold me this story of, we're going to try to own this market, build something great. We're one team. We had all these get-togethers and team building events, and then you deserted me. And I think it leaves a little bit of a mark on a person, which is really sad.
It's a mark on the whole industry, honestly. But to tie this back to Jamie Dimon, where we began this conversation, is this time different? That's got to be a question going through most AI native company CEOs' mind. Are the valuations and the rounds and the cash raised, are those going to stick around, or are we in July of 2021 and there is a 2022 coming where a lot of these companies, the water goes out and they're not worth what they say they're worth?
The answer is no. The answer is, you're a founder CEO, you're deliriously optimistic about the future, and you're definitely not thinking about any of.
But let's talk about some companies that are growing extremely fast that definitely don't have proprietary tech. So Fixer has no proprietary tech. I'm sure they are referencing, whatever model they're using. It's drafting emails and classifying emails. I was seeing on LinkedIn or Twitter, someone built basically a copycat over the weekend. What do you guys think about that? Like, these are companies that are product driven. People are buying them because the product fits a use case, but the product is effectively a commodity, like a feature that is already a commodity.
I would say that people are, the exciting part about Fixer has nothing to do with Fixer's product. It has everything to do with their distribution capabilities. They have, obviously, if you compare them to Superhuman was around for, I think, 10 years, got to 35 million in revenue. I think Fixer will be there in a couple of quarters from now. They're probably, where are they right now, Sam? Roughly like 10 million plus. They got 50. There within a year. Their acceleration isn't slowing down. And so what they've done a really good job of is earning, I think, the attention of the market. And that is a core competency that companies that are building on top of these models have to have. And so organizations that are showing that they have it, Luli being another example, I think will get the attention of investors, will get the capital required. And the other part is, can you twist and turn as the technical side of the thing is playing out? Can you find the right features? Can you build them faster than everybody else? All of those things matter, but I don't think that's where the value is really accruing. It's like, can you scale? And to scale, you need distribution. I think for a Fixer type of company, that matters a lot more than anything else. Because they don't have researchers, they don't have like these engineers. That's not what they are.
And can you scale it with a different capital structure than perhaps you'd scaled in the past? I think is one of the biggest questions. But with their venture capital, I mean, it's a lot of these round sizes are getting bigger and bigger. But if I can be a company growing 100% a year at 10 million ARR, and I've only taken one round of VC, do I need another round of VC? Because there can be a lot of fantastic exits that are not purely VC backable. along the way.
I don't know if that's possible, because if the trend is that AI makes building things easier and distribution harder, harder is another word for more expensive, which means that if the thing that is exciting about them is distribution, distribution comes at a cost, and that cost is probably significant for a company like this. I don't think these are very efficient go-to-market orgs. They're just high performing. And so you do need capital ingested in the business to be able to scale them out. And I think that's coming to mind. The one that I think about a lot is actually a company like Harvey. I think it was on the 20 VC pod where they had a really interesting conversation about this, which is that Harvey just raised at a $5 billion valuation in legal tech. And we do a lot of work in legal tech, so I know this space a bit. Harvey being invested in at $5 billion means that you believe that it can become $20 to $30 billion. Like, that's a base case outcome that you're investing into. And legal tech has just never been that type of market. Like, so you're assuming that this is now going to make legal tech a much larger market. And people say, of course it will, because AI will eat into labor costs. And that's why these markets will be bigger. And I think the point they made, and it was specifically Rory that I thought was brilliant, is it ate into a lot of labor costs and did not get the benefit of that towards their price point. And so what if this is that? And then the market, I think that's a really big question that will play out now. And there are a lot of companies like Harvey.
I think that we are in for, I think a lot of people have said this, and I think it's very true. The problem with the downturn in 2022 is that it didn't last long enough. We're right back to another bubble.
We are definitely in a bubble.
We're in a bubble right now, and bubbles pop. And when they pop, there should be massive declines. I'm like fairly pessimistic about the general outline of VC world for, call it the next couple of years. But I'm early on that.
And you know what's crazy about that, and I don't know that you probably have the data around this, but VC has not gotten the outcomes that they need to get in the last 3 to 4 years at all.
Index,
and they're not seeing liquidity at all. So it gets way worse for them.
We haven't.
Is that true if you carve out the top 5? Like, the top 5 seem to have made some money recently. Like, those firms are okay. I think the broader market, maybe not, but maybe that.
But that's the point. The broader market, yes, the top 5 get the headlines. The broader market get the returns.
Yeah, but VC is supposed to be this type of. Maybe that's more about the VC world than it is about the tech world.
I don't
because
think the
VC
top
is
5, the rest of the market gets the returns, AJ. I think the top 5 get the headlines and the returns. I think returns in VC are power law, just like the portfolio math is power law. I think like it's a small number of firms that. I think sometimes we just
than there ever has been previously.
Well, that's for sure. But I think we've been talking about the decline of like the smaller manager or the middle VC manager for a long time. But I mean, the whole way that VC works traditionally is like, if you can get liquid now, this is how your business model works. And, Index with Wiz and with like 2 other companies that are escaping my mind. Yeah, exactly. Like, I think that. And I also think sometimes we hear numbers and we don't really understand how. I don't. I'll speak for myself. I hear 32 billion, and I'm like, sounds big, but it's not just like, it's like really, really, really big.
Really big.
Like really big.
Well, I'm curious on Peter's take because he has the data to
Peter, give us you're here for a few more minutes. Over the next few minutes, can you lay out the state of venture high level for us?
Sure.
Q1, Q2 compared to previous quarters, et cetera, et cetera.
Which one of us is right?
Let's do it. Yeah. Another bet for everyone listening on our big board of bets. Here's what's going on in VC. There are massive, unprecedented level deals. Mira at Thinking Machines just raised a $2 billion seed round.
Yeah. And that's so cool. I mean, it's like insane. If that's not a bubble, she has no product.
There's no product, right? That is literally a talent bet that she gets to pay out regardless. But leave that to one side. So those deals are happening. They are getting the headlines. They are massively inflating capital raise numbers. Strip them out or simply look at deal counts down and down and down. Higher valuations, lower number of rounds. VCs are oddly conservative right now in that they are raising the threshold needed to get an investment. If you look at, say, some data from Silicon Valley Bank around Series A, used to be $1 million in ARR. You can start talking to Series A investors. Now it's 3 on median, and the upper quartile is nearly 7.
Yeah.
You have to be playing much faster to get into the VC's mindset. Now, is that good? Like, VC should be taking riskier bets, not consensus ones. And this is a general problem with the ecosystem that we see. We are the fund admin for 2,500 VC funds, usually emerging managers in the US. Those numbers, those performance data, they're not good. They're not good. Even, and this is something that is often thrown around in VC, they say, I'm going to be a top quartile 3x net fund, meaning I'm going to be in the top 25% of all funds. And that means I'm going to return 3x to my investors. That is a big bet. My instinct is that you can't be a top quartile fund and return 3x. You got to be a top decile fund. You got to be in the top 10% of VC.
I'll tell you that I'm an LP in a growth equity fund, vintage 2021.
Good luck. Sorry, Sam.
How are those updates?
0, but it's marked. We're in the J part of the curve. We're at it's marked at 0.9.
I don't want to come on here and say I'm weirdly optimistic about startups and like idea generation, but the actual how to get money, the business model of how this works on an aggregate basis, I think is really strained. No problem if you're in Andreessen or Sequoia. Big problems if you're not.
How does this differ based on stages? But because as you speak, one side of me feels like maybe venture has learned their business, which is that at a certain point, you should concentrate capital into your winners. The founders fund model does work, right? And so there's concentration happening.
No, 9 out of 10 times the founder funds model doesn't work. That's the point. They are the outlier. When it works, so concentration actually makes the winners bigger and the losers lose more.
Interesting.
Concentration is not this concentration is the opposite of a free lunch. If you concentrate and you don't have a unicorn in your portfolio, you go to zero.
But at the growth stage, like when they're concentrating, they've got a lot more signal. They're kind of like as a PE investor almost. But at the early stage, you have to kind of spread out a lot more. What's happening? What's the difference in your data between early stage and late stage?
There's a big difference in a lot of things. The biggest difference is that early stage valuations have remained very high relative to the total number of rounds going on, whereas late stage saw a dip in valuation and now it's rising back up. So late stage actually offered on a multiple basis a better entry point for a lot of these investors because they had more data and the valuations dropped a lot faster. That wasn't true at early stage. Seed, the valuations barely dropped. They're always super high. So the entry prices are much higher at the early stage, making those bets more difficult. I got to run pretty soon, but this is fun. I think that Asad was mostly wrong, but I'm interested when he was right. We'll get back.
All right, you can end with that. See you, Peter.
That makes both me and AJ happy. Thank you. Thank you, Peter. Great to see anybody.
Yeah, great to see you all. Cheers, y'all.
Sam, when you hear this venture data from Peter, what are your thoughts? Like, pull on this bubble thread a little bit more. It is feeling more and more bubbly.
Well, I think a couple of things. Like I said, the main people get rich during bubbles. I'm a big fan of bubbles.
They feel great.
They really do. I feel like I wish I was an AI researcher.
Most earnest, they really do. They really do.
I think. Although like I said when Peter was with us, the VC business model is fundamentally, if you didn't get liquid during a bubble, then you have terrible returns. Like the whole point is when there's enthusiasm in the market, that's the time to sell. So I think they're actually necessary for the ecosystem. I don't think a lot of this revenue is particularly durable, but I do think major new platforms are being built as we speak. And even in 1999 and 2000, a lot of companies went out of business, and yet Google was born and Amazon was born, and a bunch of companies that are generational are being born. I think, and I guess I'm thinking for all three of us, but especially for you and me, Asad, that don't run software businesses, how do we benefit? My experience in the past is that we do. My experience is, generally speaking, that when people are flush, they look to make all kinds of deals, and they hire more people. And so recruiting firms do really well. And they look at assets like communities and they think, oh, maybe this thing could be a a new AI kind of company, and even if it couldn't be, I'll believe
AI-enabled community.
So I like enthusiasm in the market. At the same time, I definitely do think that there are bubbly elements. I am not optimistic about these commoditized feature businesses that are scaling to 10 and 20. I don't think I don't think they have any defensibility, particularly. But I could be wrong. I'm wrong all the time. And, I think it's pretty clear that the best investor among all of us is AJ, who owns SpaceX and 3 Bitcoins. And the 3 Bitcoins are, he just sits on them as they become $10 million over, a couple of years.
And then in a few years, I just forget my wallet and where I placed it. And I'm like, whoops.
Asad, what do you think?
It does feel bubbly. It's undeniable.
But is that a bad thing or a good thing? That's my question to you.
I think it's proper fun. Like, I actually enjoy working in a bubble. Obviously, it's way more fun than working in a downturn. I think you said it well, there's positives and negatives here, because I do think that through this will be some legendary companies that come about and some fundamental change in how we live and how we operate personally and professionally will come through this period. That I feel a lot of conviction saying that. At the same time, I think and I can empathize with founders and investors when they see the same things we're seeing, which is changing how you live and how you operate personally and professionally, then you do get excited and you do get enthusiastic and you start saying, I need to back a few ideas. I need to do this. I need to do that. Competition comes about, drives valuation. I can empathize with why that's happening. It does scare me a little bit, because it means that maybe in another year or so, it's going to pop. And that's always an annoying thing when it happens. I was hanging out with some people that are the middle people between some of the leading venture funds in the US and the Middle Eastern sovereign funds. And this person is the connective tissue and feels very bearish about the market, feels like it's going to pop. And that is a very generous source of funding for these organizations, because they don't really care about much more than I want access to the technology of the companies you're investing into. That's really what the sovereigns want more than anything. And they're still now being a little bit cautious. They're like, this is feeling very bubbly. And that's a little scary to hear. So yeah, AJ, your final thoughts on this?
I'm still paranoid. I'm not as having as much fun as you guys, apparently. I'm very skittish and anxious. I love being on one hand at the tip of the spear and learning and being able to do something about it. On the other hand, I don't know. I don't like the chaos really for my people and my team, because I know where it's headed. So it's my job just to keep the ship right course and just say here's where we are, here's the good news. But at the same time, I'm interested. And I said it a couple months ago when the deal rippling news broke. I said, it's kind of fun when there's this drama that exists. And this is the first time we've had this drama. And holy cow, have we had drama the last 3 months.
It has been.
Yeah, that deal rippling thing was it's not even on the radar anymore.
Feels boring now once you have somebody like Varun deserting his soldiers.
So we as co-hosts of Topline have job security. That's great. We got plenty to really discuss until AI takes us over. But I don't know. I'm just trying to wait and see like everyone else out here. And I'm really glad that I got to hear from thought leaders like Jamie Dimon last night. Peter was great today.
Peter was great.
You guys were on fire. So this is what it's all about.
Well,
we're in the arena as podcasters.
We are. And it might be the one defendable thing left.
Are you guys ready to be on Radio City Music Hall in 2-3 years?
I was ready 5 years ago. As we close this, I have a question for the two of you. The question for the day is, what is something you have read, seen, watched, experienced in the last couple of weeks or months, you choose, that made you marvel, that made you feel like, wow? Well, anything. I'll start so you guys can think, since we don't give you guys much time to prepare for these questions. They come as we go. I think a lot about the size of the universe, because it's so hard to picture it and it's just so massive. the star after the sun that is closest to us is 4.5 light years away, which means as light leaves that star, it takes 4.5 years for it to get to Earth at the speed of light. But if you sit in the fastest spaceship we have today, it'll take you more than 10,000 years to get to that star. You're like, what? And then you realize there's billions of those stars in our galaxy, and you're like, oh my God, that's a huge galaxy. But there's also billions of those galaxies in this universe, and then my brain just stops working. And so I read something recently, which was the largest black hole, or one of the largest black holes that we've seen, the size of it. So our sun can take about 1 million Earths in it. If you just fit Earths into the sun, 1 million fit into that. If you take the largest black hole that we have seen now and start putting suns into it, it can fit 60 billion suns. And then my brain farted again and stopped working because it's like, what is this? And so that made me go, wow.
Asad goes, okay, what's something you marvel at? I'll go first. And then he brings up the universe. And then now he's going to throw it back to Sam and I.
AJ's like, that acquired live podcast. Like the New York Times guy talked about Jamie Dimon. I just marveled at Jamie Dimon.
So I will go, Asad. You and I were talking the other day, and you asked the question, AJ, do you just ever just stop? Do you just take a pause? Do you ever just take a moment for yourself? And I moved on from that conversation because no, I don't. And then yesterday morning, I was like, you know what? I'm going to make coffee, and I'm going to go sit outside in my backyard for 10 minutes. And I did. And it was awesome. And I just sat there with my coffee, no phone, and just watched birds fly and chirp on a beautiful Tuesday morning. And thank you for that, Asad. So I appreciate that.
I'm glad you took another 10 minutes.
I recently rewatched The Age of Innocence, one of Martin Scorsese's lesser known but really wonderful, beautiful movies. And it's got Daniel Day-Lewis, Michelle Pfeiffer, Winona Ryder, a bunch of other amazing people in it. And it's about turn of the century New York, and it's about haves and have-nots, and it's also about social convention, and it's about how everything we do, every behavior we do, every action we take is some kind of language that communicates some hidden meaning that is not just the stated meaning. And anyway, so there you go. That was something that made me think, and we talked about it for a while after we watched it, and also how people can be locked in these meaning social convention, meaning we behave in certain ways. This was also a thought that I had when I was on, some hallucinogenic substances about a year ago, and you realize that all of society exists as an idea in your mind. There is the people and what people think of you, money, laws and rules. They're all invisible. They're all fake. They all exist because we agree that they exist. And if you ever take a step back from them and just look at them from afar, you realize, they're useful because we don't all kill each other, but they are totally insane. And it makes me think about being willing to have people dislike you, being willing to go against convention, and the freedom of not caring what other people think, which is something I struggle with every day. So that's something that made me think.
Well, that's beautiful. I love that.
I thought this was a great episode. Good job, everybody. This was Topline 118. Find us wherever you get your podcasts, Spotify, Apple, and now YouTube. It's going to be one of our most popular channels. Thanks for listening.
There we go.
Thanks,
Bye,
everyone.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.